Dr. Siddiq, thank you so much, and my apologies for the delay in starting off here. Just please let me know if you're able to see my screen, and if there's at any point of time you want me to revisit any of the slides or any points around there. Please feel free to stop me around and begin with this. Dr. Siddiq, if you can just let me know if you're able to see my screen and see the presentation.
Yes, we can see. Thank you.
Okay, so let me just begin with a quick introduction. My name is Asutosh Upadhyay. I'm based out of Bangalore. I am general partner and co-founder at a venture fund called FortyTwo.VC. For an introduction, you know, just talking about our fund, we are a US-based fund investing in early stage and enterprise technology companies. Specifically, we focus on something what we call as cross-border opportunities, which is typically looking at opportunities which emerge between connecting North America and India markets specifically. And the idea of this sort of presentation, and I'm thankful for Dr. Siddiq for giving me this opportunity to talk to all of you, is generally to begin at a very quick introduction to what is venture capital and talk about how we sort of people like us operate, what we do, how we take decisions, and then probably quickly open up for questions and then talk about and hear into the points which you may have. So just quickly diving into this, like I said, feel free to stop me here just when I'm opening this up. I'm sure all of you know about venture capital. At the same time, what I wanted to sort of call about over here is venture capital by inherent nature is what we call as adventure capital, and largely because it is meant for putting capital behind what we call sometimes as outrageous ideas, things what you call as moonshots, things which are called hard to achieve, largely for a reason because we all do agree that entrepreneurial efforts are extremely risky. And when you try to sort of build new products and opportunities for markets which are probably existent or non existent, you need a capital of a very different kind to support it. Just to sort of double click on this one, today when we are doing a business, sources of capital can be at multiple places. We can possibly go to a bank and borrow, or we can go to some large lending institutions, or we can take capital from business houses and everything else. But most of those capital which goes behind businesses are business which have a lot of predictability built into it. That means they are businesses up and running. They are businesses which have a very clear line of sight in terms of what they build, what they sell, how well they sell. Think of every large company out there. Today, it's very easy to sort of look at them and come back and say, hey, I possibly know how this business is performed. But if you look at the other side of the spectrum, if you meet a young team, and probably as we dive deeper, we would possibly talk about one specific example which we all kind of allude to at the intersection of healthcare and venture capital as Moderna. At the time of something as outrageous as this, when you're trying to build this out, the capital which goes behind it is very sort of aware that we are taking extreme risk in supporting an idea. That's why we always call venture capital, or at least personally, I like to call it adventure capital because it is meant towards supporting something which is possibly has an extremely high risk or high chance of failure. Moving on to this, of course, around the press, all of us sort of keep listening into what's happening. And I think if you be in India or if you be in US and things around like what we call shark tankification of VCs, effectively we have almost converted this into what we call as real life shows and things around there where people come on TV and pitch and then talk about here's my business, I want so much cash for equity, and this is what I'm going to give out, and this is what beautiful things I'm building. And if you look at the VCs, they're always sort of saying, can your company become big? Can it become like a unicorn? Is it something which is worth $1 billion? Think about a Kareem or Kitoki, which you see in your neighborhood. Or probably think about companies like OpenAI or SpaceX or even Byju's who are on NITK. And people keep talking about saying that how large can this company become? Can this become $1 billion and $10 billion? The reason I'm sort of talking about this is the general sort of notion or the general way we sort of think about this industry is that all we are busy is trying to think about the most dramatic pitches, hard questions, thinking of groundbreaking ideas. But unfortunately, life is fairly boring around there. It's actually not so dramatic or adventurous. In fact, just the reality of VC investing is something to give you a sense. Today, when we invest, we probably look at 100+ pitch decks before we choose to invest in one. That means, as somebody, as a general partner in this fund, I'm literally meeting maybe five, seven, or looking at 10 odd different pitch decks every week, or probably in 50s every month. Then we are trying to study markets, we are trying to study teams, we are trying to understand that who's trying to build what. This is on one side, and which is all about thinking of what investment should we make, knowing that the chances of failure are so high. And in spite of all our efforts, what we call in the VC law, there's something, a specific term, what we call as a power law. And I'll probably come back to this term again and again through the presentation. What we call power law is typically, after looking at hundreds of decks, we might make one investment, and possibly out of the 10 investments which we make, just one kind of delivers the kind of return which we are looking to achieve. So if you look at it as a long funnel in terms of activities which we are trying to do, we are meeting so many companies. We are probably thinking we are doing so much of due diligence. We are probably evaluating markets. We are thinking that we are choosing the best team. In spite of all our best efforts, it sort of translates to this very poor ratio of investing to good outcomes. I think the closest analogy, and sort of looking at the audience in the room, is how people look at drug discovery or drug development, etc. There's so much trial which goes through before we find something interesting or pursuable. So overall, the bottom line is, as a VC today, what we are effectively doing is we are looking at something, finding an opportunity which is going to be possibly the next biggest company on the earth. And it is not sort of surprising that when you meet a bunch of VCs, they will all be constantly trying to sort of say that I think I have the best company out there. In spite of everything else, it still doesn't reach anywhere. So that's a quick sort of reality check in terms of what VC investing is all about. I just want to take a small detour here about history of VC funding. It, like a lot of good things, they started off in the US in very early 1950s and 60s in what we call in Silicon Valley. Uh, Early days of VC was very different. We weren't actually investing in software. Those early days, the biggest thing out there was semiconductors, chips, transistors, and things like those. So in early 1950s, there was a company called Fairchild Semiconductor which came in, and this literally got formed because there were a group of 8 people who were working at another semiconductor company. They stepped out to form a company called Fairchild Semiconductor, and it's probably the first example of a VC funding happening there. Surprisingly, while these guys were apparently doing good things, their bosses called them Traitorous 8, and that is a name which has got stuck on with that group. That subsequently led to VC firms like Kleiner Perkins and someone who is a lot more commonly known, Sequoia Capital, kind of setting in. And early days of VC was all about supporting these companies. So today, when we look at technology markets or something like public markets in US, Nasdaq, etc., a large part of the companies were VC funded at some point of time. Today, when we look at those companies, they all sort of look like such attractive companies. But imagine if you look at a Netflix probably 20 years back when they were still, or 15 years back when they were still shipping movie DVDs or cassettes across to people via US Post. They never looked like these interesting companies. And that's why I go back again and again that VC funding is always done towards hoping that something can become insanely large. Over a period of time, the whole industry has expanded. There's a lot more capital which has come in and which has made entrepreneurship simpler, I would say. At the same time, the chances of success remain where they are. And like everything, like every financial industry, the industry also has gone through its own set of ups and downs. So every now and then you might have heard of terms like dot-com bubble or a financial crisis, Lehman Brothers, or the Great Financial Crisis, etc. At the same time, things have moved outside of US where it all began. So today, places like China, India, including funds in Middle East like Middle East Venture Partners or Vamda Capital and all, there's so many new funds who have come up in different geographies, which effectively helps regional entrepreneurs get access to capital and think about building something more interesting. All in all, the way to look at it is last 30, 40 years, the industry has scaled heavily. It is that capital which is kind of driving innovation and which continues to do this. And over a period of time, the whole venture capital industry has become more specialized. So today, there are venture capital funds like us who specifically invest just in one category of companies. We do not invest in a bunch of companies. There are people who are spending money, large corporates are investing, people like Shell, people in the healthcare space. There are different people who are investing. So, if I'm not mistaken, I believe Cleveland Clinic has probably about a $2 billion capital set aside just for investing in healthcare. And if with all of those things, there's so much more specialized capital which is coming in. Also, it's kind of moving forward where people are looking at investing in things which are closer to climate, sustainability, impact, financial inclusion, and also looking at women entrepreneurs and supporting them around. So just a way to think of it is what started off as from that first instance of Traitless 8 and moving all the way over here where there's so much of capital and so much of specialized capital which is looking at specific opportunities. We have really, really come a long way here. But like I said, this is not enough. I mean, there's always a need for more. So this is where we are. I'll just quickly sort of run through if we all kind of know about what kind of success stories. We all know about Uber, we all know about Airbnb and SpaceX, but very specific to the audience in the room, companies like Moderna, 23andMe, or Butterfly, these are all examples of people who have gone and invested money in their focused opportunities. As we sort of look at things around us, specifically in UAE, Careem, Kitopi, Tabby, all of these are great examples of companies which have come up and created value. And these are kind of successes which are there. At the same time, what we still don't talk much about openly is how much of failures sort of happen on a regular basis. But then that's a topic of a longer conversation, and there are probably a million reasons why these things don't scale. But the key thing to watch out over here is when things really scale, they really, really become big. And each of these names which I have listed out here, these are like really large companies which have just kind of used venture capital to drive innovation and then bring things around. Now, while we sort of keep talking about things like this, I just want to sort of give you a quick glimpse in terms of kind of now and specific terms which you would come across in a venture capital world. People often talk about this in press. I'm just trying to sort of share some of these terms and some of how the economics of a venture capital work. So largely, if you meet a someone like me in a fund structure, I am who's called a general partner, and I'm kind of responsible for making investments, managing the capital, running day-to-day operations. And as somebody running this whole process, I'm eligible to receive a share of profits which we generate. At the same time, a fund is supported by people who are known as limited partners. They're called limited partners because they have a very passive involvement in the whole business. What it means is they're not actively involved in taking decisions. They're generally advising at best. They're looking at this purely as a financial investment, and that means they have limited liability and involvement. They do not make any executive decisions. They're not people who are choosing which investments to do, which not to do. But these are what called as limited partners. And just to give you an example of institutional limited partners, Mubadala, Adia, all of these guys are really large limited partners out there in a bunch of venture funds across the world. Now that's on a fund structure. Often people in the press talk about making releases that they've raised their seed fund, they've raised their Series A, Series B. While these are like terminologies which we sort of choose to give ourselves, but if you look at a business in a specific stage, like all companies or young businesses, these are companies which are trying to move across stages. Typically, we call something like a seed stage investment, where some capital is given to an entrepreneur to develop a product or a service. The way to look at it is almost like a idea which is on paper or something very small and minuscule which has been built out, but very little validation of whether it will work or not. The whole idea of seed investment is to, just like how we say seed, I mean, the whole idea is to seed an idea, allow it to run for some time before it gathers some momentum. The second one, more often than, is something called Series A, which is effectively saying that now that you have a product, possibly there are some early customers who have shown interest in using your product. Can you use that money to scale your business? Effectively, when you look at the risk from a business, the risk has reduced compared to a seed, and the chances of making returns start looking slightly better. Then the next one is something called Series B and beyond. These are things what we call as growth. Effectively, a company will come back and say, hey, I have a working product. I have validated that I have customers now. I know how to make money on any money which I put behind business. So for example, if I spend about $100 on marketing, can I make a $500 out of it or $300 out of it? The whole idea is what we call as growth. That means the business has reached a stage where it should start multiplying money. And that's what is typically Series B and beyond. Of course, there are a lot of companies which still don't make money, and even after reaching public markets, and that's a topic we can probably touch upon later in the conversation. Now, just from what, like I said about the economics of venture capital, most important thing is it's extremely hard to kind of deliver returns which can beat even a stock market or a fix this one. So a lot of people who go into public markets, VC returns are supposed to be doing better than that because they're supposed to be risky. That means you deliver what you call as an internal rate of return about 15 to 25%. But you would be surprised to know only top quartile VC funds are able to meet 15 to 25%. A lot of funds are unable to even kind of deliver the kind of returns which they have invested. It's just like I keep indicating, it's just an indication of how risky the investments can be. And it's all because, like I said, a high failure rate. 1 in 10 fail to provide significant returns. Second bit is, unlike public stocks where you can buy and sell and do it at any point of time, these are companies which are not in a stage to return capital before a certain time period. So typically, it really takes a company good 5, 6, 10 years to reach that kind of stage. That's one. And the last bit is, of course, with respect to what a market and industry risk is. There can be risk coming in from any quarter. I mean, today the world is looking at some amount of financial risk. All of you guys might have, or most of you might have heard about Silicon Valley Bank in the US and the bank run which happened where people sort of, uh, the bank was in risk. Now, these are things which are unforeseen in nature. These are things which can happen to anyone. There's almost like coming back and saying some catastrophic or tragic stuff happening. So, because of which all of these factors, it's a venture capital is treated as an extremely risky asset class. At the same time, it is probably an asset class which is capable of generating 100x returns. What I mean to say about that is, unlike any other stock, unlike any other investment asset class, it's extremely unlikely that anyone can meet the venture capital kind of returns. There are kind of companies who would have probably delivered 100, 200x kind of an investment, which would have gone into some of those companies. Before I sort of go into the crux of this presentation, I just quickly wanted to take a pause here if anyone has a question, because this is exactly the key aspect of this presentation, that how do we decide an investment. I can take a pause, and if you have any questions, you can please feel free to shoot something at me.
One question here. At what level does a venture capitalist firm typically invest? Idea, prototype, MVP, which is the best to have before pitching to a VC firm?
So it depends on the kind of VC firms which exist. So for example, there are people who specialize on idea stage investments. There are people so VC firms as a category, or rather the industry, is divided across multiple stages, because at every stage, it requires a sort of a different skill set to evaluate a company. Now, let's take a team which is coming in with a strong expertise or a domain, and then let's make it more contextual here. That someone comes in from healthcare. Interestingly, just today morning, someone I know reached out from US who's working on protein synthesis and looking at specific proteins to be developed for oncology. My terms might be wrong. Please correct me over here. That's because that's not a domain which I know too well. But now, for us, if I treat this as a sort of a specific case to look at, these are 3 PhDs. 2 of them are protein engineers, and one of them has been in data science for pretty much all his life. These guys are coming up with a very specific use case of saying we want to build certain protein which can be used for treatment for certain kind of oncology cases. Now, if someone like me were to look at it, I don't come from healthcare so much, but if there's a healthcare specialist fund, he will look at this and he'll probably say, hey, I want to invest in this now. I know the risk is very, very high, but if all things go well, I can make a lot of returns. So these are people who sort of specialize at looking at some early stage. There are another set of people who come back and say, I know the idea is great, but I'm not going to invest until once the company is making 20, $30 million of revenue a year. So the industry is kind of categorized by different funds who operate at different stages. So depending on the stage of the team, where they stand in their own life cycle, is advisable to go to the right set of people. Often, and it's a very nice question which you brought up, because a lot of founders sometimes come back and say, I met a VC, he took my time, he spent time with me, but he didn't invest at all. There can be a mismatch because the VC is used to investing at a different stage. So a short answer to your question is that people exist across different stages. It's most important to go to the people who understand the domain in which you are building the business and who also have a comfort with the stage. And there is enough capital which is available to solve for each of this. So for example, if I look at US or even India or Middle East, there are a lot of people who are angel investors and who just go and back a team just on a paper plan. And that's what we will call as an angel investor or friends and family rounds which are happening. I think if someone's starting off, the best thing which I always recommend, go to first angels, friends, and family, because they are the most patient. They're willing to take risk with your business and on your business, and they are willing to back you at that point of time. As you start building your product out, go to people who are called possibly the seed investors, and as you sort of scale, keep moving to stages above and above, and that's the best way to sort of run it. A lot of efforts go wasted when people end up going and talking to the wrong set of people. And it's very hard to sort of, since there's not much information available outside, it's very hard to kind of figure out that who's investing at what stage. So one bit which we always recommend is whenever you are trying to meet a VC, do some research on using website, using public information, what kind of companies they have invested in, what stage they have invested in. It will give you a good idea in terms of what is a preferred sweet spot, and pick that up from there and then look at investing in them. Did that was that clear?
Thank you, Dr. Asutosh. You can move to the next presentation.
Sure. Yeah. So let's sort of now move to the main construct, or rather the core of this presentation, where we're talking about how things work and how VCs make decisions. So the first and foremost thing in the VC business, like I said, deal sourcing is a majority part of our time. What it means is we have to be looking at X number of companies. We are constantly looking at companies because the idea is that until unless we are covering the whole landscape, we may or may not be getting the access to the best team. So deal sourcing is an essential part of everyone's day-to-day job in a fund, which means we are spending time at events. We are meeting other funds who can be referring. We can be meeting people like you because you might be looking at a team. You might be aware of some startup or some technology company which is working in your business premises, and people around there to find those opportunities. And that is something which is there. Once we meet a team, we're actually looking at specifically three, four aspects. The first thing is what we call as market potential. What it means for us, if we do some sort of estimation of the market size, which means in terms of revenue, how much money can be actually made if somebody were to own 1% of this market or 5% of this market or 10% of this market. Think of this way, that if I were to be sort of building a Zoom like product or a Microsoft Teams like product, all of a sudden, I would look at every office worker who has access to a desktop machine as a potential user. And that's my large universe. I'll subsequently look at that large universe and put some assumption around there saying that if out of this entire universe, about, let's say, 5% of the people are willing to pay for something like this. And if they're willing to pay me, let's say $1, $5, $10, and we try and do some sort of calculation to identify that if all things work, can this industry give us $1 billion a year of revenue, or can it give us $5 billion, $10 billion, and more? Healthcare specifically is a very interesting segment because on the face of it, it's a huge market. Looking at the spend which governments are doing, people are doing, hospital service providers are doing, on the face of it, it looks an extremely, extremely rich market. However, the more interesting thing is we have to zero down and identify, just not say that I'm building something for healthcare and healthcare is probably a couple of $1 trillion globally, is something which I should go and build and everything is investable. What we need to do is we need to peel the layers over here and try and identify that what exactly am I solving for? So what we typically call is top-down estimation and bottom-up estimation. An example of bottom-up estimation is, let's say in a city, there's an X population out of which Y is an aging population, and they'll need about maybe certain amount of dollar spend happening every month on their healthcare checkups or diagnostics or things like those. If I just look at that and come back and say if I'm operating in, let's say, in a city like Bangalore, or am I sitting and operating in Abu Dhabi or Dubai or any other place, what is the addressable head count around there and how much money will people spend? Can it make a large business or not? So first and foremost, we actually spend a lot of time trying to identify addressable market. Anything as a rule of thumb, which is less than a couple of $1 billion, is not an interesting market. For a very simple reason that even the biggest companies fail to sort of own more than 10 to 20% of the market. What it means is if we do a calculation of about, let's say, providing geriatric care in India, while there's a large population, unfortunately, the capacity to pay is very, very small, because of which it might look like it that there is an aging population, but we do not have enough people. While we have enough people, they cannot pay. If they cannot pay, if it doesn't look like that this is going to be a 20, 30, $50 billion business, that means it is, even if you're the largest company, at best you can make $1 billion of revenue or making maybe $100 million of revenue. If that is the case, which means the market leader is going to make only $100 million, then this business is not exciting enough. Hence, we spend a lot of time trying to understand market potential. And this is done both actively and passively. What I mean is, we do it actively when we meet a company. Let's say we are meeting a company, we have no idea about the market, then we really put our heads down in trying to study the market. At the same time, we actively keep scanning sectors after sectors to understand that which market can spend how much. I mean, just to give you a plain contrasting thing, today, if you ask me, will I be investing in a geriatric care business in India? Probably no. But if you ask me, am I willing to invest in a coffee shop business which is addressing the millennials? Yes. Because the millennials are going to turn up every day, they're going to spend X amount of money on coffee. I don't expect the geriatric population to be able to spend so much. And that's why one business is more interesting over the other. This is just on the market side of things. Looking at the second most aspect is visualize this that the company is nothing at early stage as a team which is going to drive this vision of building a business out. That means the team is pretty much the key to success around here. And we actually spend a lot of time trying to understand that what is that unique skill set, what is that unique insight, or what is that unique past pedigree or experience which a team carries, which says that they have a better chance of winning in this business over anyone else. Now, this is a very sort of qualitative exercise. It's very hard to kind of bet on people and come back and say, hey, this team is better than the other one. We look at very qualitative aspects. So, for example, if someone incoming is saying that he's trying to sort of, if someone like me were to turn up, go to another VC and say, I'm trying to build something in the healthcare space, or let's say drug discovery, he'll shoot me down in no time because I have absolutely no experience. But think of this way that if I were to go to someone and I've personally worked in financial technology in the past, go to a VC and say, I'm trying to build something on the insurance space, he might look at me slightly differently if I were to talk about drug discovery. So the reason I talk about this is teams are key to a success. And the founder and the team's vision, the team's sort of dedication to the idea, the team's willingness to stick around on that idea, irrespective of the kind of hardship which they might have to face, is very, very essential. So not only we are looking at past domain knowledge, we are also looking at their ability to execute. And when we say ability to execute, it is just about knowing how to build a product, sell a product. It is also about how do you people, because just three, four founders cannot run the entire business on their own. You have to be scaling your company. So tomorrow, let's say you're running a multi-country business. I mean, you really need to know, be sensitive about local culture. You really need to be sensitive about work practices, how you build that thing around, and that's very, very essential in terms of look at it. So founders or teams, so to say, we look at things like complementary skill sets. Somebody can be very good at technology, somebody can be a good CEO, he can be a people leader. And the last and the foremost thing is considering that you're in a business where you're trying to raise capital, your ability to raise capital is also a sort of an art which we look for. Very hard to kind of define externally. It's almost like, we over a period of time, all of us tend to develop a nose around there, which means we have a point of view that we think this founder can do this cannot do this, and a mix of it. But market and team are two very, very important factors. The third one is something what we specifically focus is called product and technology innovation. What it means is, are you building something unique? If this is unique, is this defendable? Does it have an IP? Can this IP be protected? Can this IP help you have an advantage over the competition? That is essential. But among all things, I would say market potential and team are more important for us than product and technology, because we believe with the right teams, you can build the right product out. You can innovate around technology. But if you don't have the first two, it is very unlikely that you'll be able to get to the third. The fourth one is a slightly more hygiene in terms of business model. It is largely about saying that, let's say now that you are a great team, you have a great idea, you have built a great product, and there's a large market. But how do you price your business? How do you sell your product? How do you price your product? How do you distribute your product? Those are kind of things which matter. Does that, I mean, we sometimes talk about specifically in our area of focus is something called software as a service, SaaS models. Now, the whole idea SaaS is a very interesting business because it is sold in a subscription model. It means I sell it to you once and you keep paying for me every month, every quarter, every 6 months, every 1 year. It is a very interesting business model because it compounds revenues. That means while I am busy making sales, let's say I sold something to you today, I don't have to come and sell you again next year. As long as you are using the product, you'll keep sending me money. You have rented my product and you'll keep sending my money to me. There's an element of compounding. So these are things which we sort of look at in terms of why is this business model unique over something else. I mean, somebody can just go build a business around their technology that every time you send deliver drug or you sort of give someone something, you got to pay a royalty fee around there. And now that's an interesting business model because whosoever developed that product or drug doesn't have to do anything more. He just keeps getting paid as long as it keeps getting consumed. That's why the business model is essential. But if I were to sort of revisit this due diligence exercise, and since this being the core of our topic today, market potential and teams are the most important thing. One of the things which we always come back and say in our industry, a great team in a poor market is still okay for us than a poor team in a great market. Great teams have the ability to find and expand their market. That means if they're building something today which is probably small, they'll find a way to change their product to appeal to a larger business. That's why teams are the start point for people like us, and specifically people like us who invest in early stages of an idea. The way to visualize this is if you think of this like a car, as an investor, you are sitting in the car and the founder is the one who is holding the steering wheel. You are entirely dependent on his skill set, his motivation, his energy levels to get you across the finish line. And that's why teams are the first and foremost important thing. So a suggestion, if you're ever getting into a VC conversation, is very essential that as a team you are able to demonstrate and convey to the VC that why are you the best team to possibly build something like this. which means talking about past expertise, talking about domain knowledge, demonstrate execution capability. All of these things are essential. Uh, Market potential, like I said, is the second largest key factor, largely for a fact that small markets typically don't allow a large business to get created. Hence, sometimes you would hear that companies begin in one country and then they go to other countries because maybe the place where they started off doesn't give an opportunity for them to build a large business. That's why they have to go and take their business out. I mean, again, citing from our own personal example, we invest in companies specifically who are using software engineers in India to build their business out, but they're trying to sell in North America because North America is probably a large software market. That means if they were trying to sell the same product here in India, they may not make that large a company. But if you go to the other market, you possibly can do this. I'll take a pause here once again. I'm sure there might be some questions which might come up over here. Happy to take something before we sort of move to the next section. Should I move to the next section now?
Yes. Next section. I can't see any questions here. Thank you.
Okay, all right. Yeah. So let's say if I run through this process, think of this way that I go to an event, I meet a great team, I like what they're doing. We run through all of the steps of finding the market, the team is interesting. We look at what the product they're building is great, the business model is great. So think of this like a checklist. Everything is great, great, great up to here. Now comes the business of doing our business, which is about saying, okay, we want to invest in something like this. The whole thing here kind of moves into a sort of a commercial conversation. It's almost like a negotiation which happens around at that point of time. They're saying, hey, we like your business. And let's say a founder comes and says, I want $2 million to build the first version of my product out and then show it to a couple of customers. And then in our mind, we are okay with the $2 million because we have that money to give. Then we actually sit down in negotiating saying, okay, here's your company. We want a certain portion of your company. What do you call as equity, as ownership in your company? So we kind of sit and discuss across the table saying, hey, I want $2 million. I'll give you $2 million, but I want 20% of your company, which means I value your company 5 times. That means you're worth $10 million today. Now, these are very ad hoc conversations. There are not at early stages, there's no sort of financial model which says idea of this nature should be given $2 million and hence the company is worth so much. Effectively, what we do over at this stages is we say what is the best ownership which is favorable for us and also ensure that the founders also have enough equity for themselves. I mean, think of this way that you're starting a company, but day one, if you give 80% of the ownership of your company to someone else, and let's say the company becomes, after all your best efforts, maybe worth $100 million. And imagine exciting opportunity. At the same time, we don't want to own it up so much that there's no upside for the founder. That's why the whole deal terms, negotiations, equity structures, etc. happen. And once that's kind of done, we agree to making an investment, and there's a legal process, which depending on which country you are operating in, the kind of structures which are legally mandated locally, each region and everything. There are some nuances, but broadly these are like similar structures across the globe, and we come and make an investment. Once this is done, now think of this way like we are partners for life, because it's not like if you don't like the company and if it's not working out, we can just tell you to buy us back or give us our money back and move on, because most companies cannot do this. It is in our interest as a VC investor is to work along with the company and make it successful. And that is the point where actually choosing the right partner is very, very essential. As when I say a right partner, think of this way that the investor is a partner now. Someone who can help you get more customers, someone who can help you raise more money in future, someone who can help you get access to your customers, uh, help you scaling your business. This is the essential part of what an investor does and is supposed to do, because like I said, if it's a company where the founder owns 80% and the investor owns 20%, we are equally skin in the game and we own 20% and we want the company to succeed. That means we, and most of us in the industry, work very closely with our portfolio on helping them on strategy guidance, helping them access capital. We actively introduce them to potential new investors. We actively introduce them to customers, everything with the idea that if the more we support our company, the more successful they will become, and hence the more money we can make. And that's the reason why portfolio support is a very essential thing to do. So in fact, one of the things which I recommend entrepreneurs always to do, that when you're choosing to take money from a specific fund, while they are sort of trying to study you, you should also study them, trying to figure out how do they operate, what kind of demands they put. Do reference check about the funds also. Do a reference check with the founders who have raised money from the same fund in the past. Go and talk to them, understand the operating style. And end of the day, this is a people business. We are humans at the end of the day. As an investor, I may represent a fund. As a founder, you can represent your company. But end of the day, we are two people in a room. If we don't align, if we don't sort of resonate with the same vision, then it kind of creates like what you call a bad marriage. And that's something which is probably the most toxic thing which can happen to a company. Like I said, a lot of failures happen in this industry. Founders fall apart. Founders and investors don't get along. A lot of things, and some of these things can be best avoided by sort of spending time trying to understand each other and discover each other's working style. And that's the essential around here. Just summarizing this slide, like I said, sourcing is a very key part of our business. The way we sort of make a decision is an extremely sort of involved process. Sometimes it takes a lot of time, sometimes we try and run fast, but then it's a very conscious process of trying to understand how large a company can become, how large the market is this the best team, is this the team which we want to work along with, we believe in the team's vision and we are sort of energized by what they are bringing on the table, etc. And then we sort of formalize those investments using legal contracts. We formalize them by putting structures, ownership, governance, like a board, etc., getting formed, a board of directors being built around there, and then moving to the path of walking in this journey of building the company successfully, what we call as a portfolio support. And this, in a nutshell, is what happens during a investment. The investor evaluates, takes a decision, gets in, and then works and hopes that we can kind of get to the return around there. But I keep qualifying this at every stage. In spite of so much, keep in mind there's so much of uncertainty, there's so much of sort of innumerable ways where things can go wrong. The power law of VC still holds. On an average, it's only 1 in 10 company that actually can give you the kind of returns which you're looking for. So just to sort of illustrate this a little more, on an average, every 10 investments which you'll make, probably 5 will come down to zero. So imagine if you give $2 million to 5 companies, that $10 million becomes zero. There's a high likelihood that one company who gave out of that 10, $2 million will probably make it a 20 or a 30 or a $50 million out of it because they scale so well. And the whole idea is to find that company. And that is what sometimes people say, hey, I have a unicorn in the portfolio and I have a decacorn and a petacorn and everything else. That's what it is. I'll move to the next slide. This is specific to the audience in the room. I'll probably start from the third section on the slide and then come on the first one. Most important thing is, as somebody in the space, if you're thinking of starting off, I'm sure with everyone's exposure or around the healthcare as an industry, I'm sure you would be seeing enough number of gaps and white spaces or opportunities to go fix something or build something which can elevate the patient experience, elevate the kind of care which is being given. I'm sure each of you would be aware of something around there. But then that's just a problem. The other way to look at it is a problem has to be solved and what is a solution. And the journey of taking the solution and converting into a business is the key thing. Because as soon as you start solving that problem and is just not enough. It's just like fixing something. But when you have to convert it in a business, is where the whole aspect of entrepreneurship and innovation kicks in. That's one side of it, is someone sort of motivated to be an entrepreneur. The other side is be mentors and advisors in the whole ecosystem. There are enough and more people who are trying to sort of build this out as people who may or may not have a genuine sort of knowledge or a first-hand experience of having done this. But this is something which is uh, that something I would say that is a very essential skill which a lot of people in the healthcare industry can play. The last and the other thing is, of course, we people can look at this as an asset class. People can look at investing in this asset class and things like those. So this is something which is there. With this, I kind of complete my slides. Happy to take any questions at this stage.
Thank you, Asutosh, for that wonderful talk. And I think I learned loads actually. I think the risk which you take is what rewards you so much. So as a healthcare, we're a risk-averse industry. We don't like taking risks, and that has hindered innovation to large extent in healthcare because we like doing things which we know works, and that has meant that we've not been able to adopt a lot of these emerging technologies. Even our EMR, as you know, looks that it was developed in the 1970s. So I've got a few questions here from people. Um, how does a new person without much experience approach an investor? And what are the key points behind approaching an investor for the first time?
Sure. So I think when you approach an investor, we have to sort of look at it this way, that it's almost like a conversation which is supposed to happen. And what I always recommend is, when you're planning to meet an investor, let's say I'm sure there is a specific idea which you want to run past. It can be a well developed idea, or it can be an idea which is still in the making. The reason I say in between one of them, because when you approach an investor, you actually want him to know beforehand, saying that why am I here to meet you? Is it like I want to bounce off an idea and I want to take your feedback, saying that where it would land up? Or I've already built something out and I'm trying to raise capital. So it's very important to sort of set a context ahead of time. For example, today we keep meeting people who are already in their jobs, who are thinking of building out, and they come to us and saying, I'm thinking of this space, do you have a point of view? So it's very important first set a context, and this is largely dependent on where you stand in your own journey of entrepreneurship. Have you built out something? Are you thinking of building out? And once you sort of do that, it almost becomes like an introduction of who you are or what you are doing. So sort of putting that into place is very important. The second aspect of doing things over here is to study the investor. And within investor ecosystem, there are a lot of people. There are people who are partners, who are seniors, and there are people who are associates, analysts, principal. These are various designations in a venture fund. Do keep look at a person and understand that what has he been doing. Uh, Most of us are very active on social media. We are either writing on LinkedIn, or we are, writing, blogging, and telling what we are investing in. I would always suggest do a little bit of a research about the person. See to it there is an alignment in terms of interest, or at least the person is aware about your domain. So think of this way, that on one hand, you have a context of what you want to talk to the person. The second hand is, this person is his interest and other things. It's very easy to reach out to most investors because we are in the business of talking to people. You can choose to write to someone directly, or you can choose for a warm introduction. Either of it is fine. In fact, some people actually appreciate direct outbounds rather than waiting for a warm introduction. Having said that, approach the investor, introduce yourself, saying who are you, what have you done, because we are always very interested in meeting people. We are very always interested in knowing who's building, because we also look at this as an opportunity to learn. I mean, my thing is, every time I've spoken or exchanged messages with Dr. Sid, I've always learned. And this is very interesting. So think of this way, that we are open. Once you get into the meeting, after you have introduced yourself, do let the other person kind of talk about their interest and focus areas and things like that, so that you need to know them a little better. Then probably present your idea and talk to them and saying, what have you built up till now? What are you hoping to achieve? Why do you, most important thing, and I think it's a very important question, is is to kind of explain that why are you doing what you're doing, which is effectively saying what is your motivation to do what you are doing. And this is the most important thing, because otherwise you're not having a serious conversation, and that is what people want to know. Why do you think solving a particular problem is important? Is it just because you had that experience, or is it because you think this is going to create a large impact on a lot of people? All of those things are critical. So think of this way, that always structure this conversation: introduction, context, what are you building and why are you building, and see to it that whosoever you're meeting has some sort of background or familiarity with what you're doing to make the conversation meaningful. And then lead it this and this automatically, more often than not, such good conversations graduate to a stage two where the investor wants to know your business more. At best, he will come back and say, hey, I like this now. I want to invest now, or maybe let's meet after you've reached certain milestone. But this is what a good conversation looks like.
Thank you very much. I think you answered the other two questions, which were what stage should the company start approaching investors, and the last one, how critical is ideology matching when choosing an investor? I think the final question would be, how long can we expect the raising investment cycle to typically last?
So these are a little bit of seasonality around there. I think if you were to ask me this question about a year back, things were in a very, very sort of different sentiment. We were taking decisions in a week at times. Nowadays, because of the kind of change in the financial markets, etc., and a little bit of pullback, people have gone a little cautious. But typically, the way to expect is no's are quick to come more often than not. So you will get to know a no probably in the first two meetings, or maybe a week, 10 days of saying what it is. But the yeses tend to take a little longer. So more often than not, like I said, because we are meeting so many people, we are actually in that mode of saying, hey, this is not interesting, this is not a fit for us. So we are, whenever it's an outright no, the no's happen very quickly. It's just that the yeses take a lot of time, and these days, I mean, personally, we have spent about good 60 days on a transaction before we have said yes.
Thank you very much, Asutosh. I think there are lots of pearls of wisdom there for me too, actually. This is recorded. Is it okay if I share it with my residents again, especially the bits about how you develop a team and how do you approach a VC? I think that'll be very helpful. And thank you again for your time, and thanks to those who attended this talk. I hope that it's been inspiring. And thank you very much for your time again, everyone, today evening, and look forward to being in touch. Thank you.
Thank you. Thank you so much for the opportunity. And I'm on LinkedIn, so if at any point of time anyone has a question, do feel free to reach out. And thank you, Dr. Siddiq, for this opportunity. Glad to be here. Have a good day. Good evening, everyone.